Josh, Emanuel, let's talk about asset allocation in what's been a very interesting election year. Should I change my portfolio because Bernie Sanders and Donald Trump have been racking up delegates?
Yeah, it's a good question. I mean, we have to appreciate the fact that what's happening in the elections today has created certainly a great deal of uncertainty, as opposed to having candidates that are, starting from the center and moving from to the left or right from there. You have these very extreme kind of anti-establishment types of movements. I think, frankly, on a global basis even, but particularly in this election, I think that risk and that uncertainty has yet to be priced into the market. So I think you will start to, because of the lack of certainty around their policies, it will take some time. So I think investors need to be just wary of risk today, not reach for risk, because we've already seen some volatility on a year-to-date basis, and it's very likely that as we move, further into the election year, more uncertainty might start to get priced into the market.
Meanwhile, you're seeing stagflation in the economy. How do you reconcile that with the job growth we've been seeing?
Yeah, so it's a good question. So what we've seen in terms of the jobs numbers have been great, and it's a sign that there is healing that's taking place in the employment level. But what you've seen on an inflationary basis is not as good of a picture, right? So you haven't seen, wage inflation in January was good, wage inflation in February was not so good. And so that obviously gives the Fed, a reason to potentially hold off, right? Because from an inflationary perspective, you look at what's happening in the commodity complex, you look at PCE numbers, personal consumption expenditures, not quite at Fed level targets. So what we see right now on a global basis is declining levels of inflation, which is certainly a function of the commodity complex, broadly speaking, but that married with slower economic growth on a global basis and slower earnings growth. So those concerns really warrant for being mindful of risk in this environment.
So if the Fed does hold off with their interest rate hikes, that should be good for high yield. But meanwhile, you are wary of high yield right now. Why is that?
Yeah, it's a good question. So with respect to high yield, what we have today is we have much wider spreads. So certainly valuations today are without a doubt more attractive than they were 6 or 7 months ago. And more risk has started to get priced into the market. We've seen a bit of a recovery in high yield prices over the past month or so. On some recovery in earnings or commodity prices. But it's important for investors to recognize that even at these levels, with energy prices, WTI crude at about $37, $38 roughly today, even at these levels, you're potentially looking at maybe half of energy companies in the high yield space going bankrupt. So we still need to see some significant recovery. And so given that, things could get worse before they get better in high yield.
All right, so drilling down even further, when it comes to equities, you are also not as sanguine on equities. You like alternatives, long, short, better than straight equities. Explain that.
Yeah, so what we're seeing in the equity market is, and what we're really seeing in earnings is really a decline consistently over the past 3 to 4 quarters. Last quarter it was negative 3.4% roughly in earnings growth for the fourth quarter. That was slightly better than expectations, but you're looking at 3 quarters in a row of declining earnings growth, and that's a concerning sign. Now, a lot of that is a function of the energy market, certainly a function of the dollar, which both could reverse and improve the market conditions, certainly. But even despite that, what we're looking at is still relative to longer-term 5-year and 10-year average forward price-to-earnings ratios, you're still looking at about a 16 versus what historically is 14 and a half. So even with what has been a modest correction in markets, with lower levels of earnings growth and still valuations that are slightly rich relative to history, one has to be, I think, cautious about equity risk. So for that reason, we're not calling for I wouldn't call for a crisis of any kind per se, but for that reason, substituting some of your risk budget out of pure equity risk and into areas where, long, short, perhaps, or event-driven, as an example, opportunistic credit type strategies, as an example. Those can be areas where you're taking both a long position and a short position, and you can add some value while still having some market risk in your portfolio.
All right, well, thanks a lot, Josh.
Thank you, Greg.
And thank you for watching The Street.